When I bought my first stock in 1968, a few shares of Hospital Corporation of America, HCA, bought with my lawn mowing money that had been saved at $2 a lawn with the clipping thrown in that $2 price. HCA then owned a one hospital called Parkview in Nashville. I did not appreciate then that the U.S. economy was in the early stages of a very long problematic inflation period that would last until the early 1980s. Both bonds and stocks filled as asset classes during that period starting in the mid-60s and into the early 1980s, due primarily to persistently high inflation numbers that resulted also in high interest rates. The S&P 500, starting on January 1st, 1966 through July 1982, had an annual average total return of minus 1.813%. That is with dividends reinvested, adjusted for inflation, and over that period of time at an annual minus 1.813%. Bonds were in a bear market as well during that period, but started much earlier due to, at least in significant part, to the Federal Reserve suppressing the 10-year Treasury yield below 2.5% for several years after World War II when inflation was running hot. By hot, I think there was one year that went over 10%. When the Fed ceased its rate manipulation around 1950, the result was like holding a balloon underwater and then letting go. The 10-year Treasury yield went up and a long-term bear market in bonds lasting about 32 years started. There is a chart of the 10-year Treasury yield starting in 1790 to 2011 is the pertinent period that I'm going to use here. The bond bear market started in 1950, 1951 when the Fed ceased suppressing interest rates and it peaked in 1981. What followed after 1981 was a long-term bull market in bonds. And this is the chart that I'm going to show you. You can see the peak rise in the 10-year yield. At one point in 1981, the yield went over 15%. The bond bear market started off slow, but then gathered steam in the 1960s and throughout the 1970s. In 1981, you could have bought a 30-year Treasury bond with a 15% yield. The yield now is close to 4.66%. I'm discussing this history which I lived through as an investor since that memory is seared into my brain. I formed a steadfast opinion during that period of time that I hold to this day. When you experience firsthand the devastation caused by prolonged high inflation numbers, you do not need to be convinced by anyone that the Fed's first priority is to nip inflation before it becomes high and embedded in the economy, even if that means the unemployment rises some from what is now a historically low number. More suffering will result from letting inflation run higher. The second biggest policy mistake ever made by the Federal Reserve was to keep expansionary monetary policies known as ZIRP, zero interest rates, and QE, quantitative easing, through 2021 and into the first quarter of 2022, when inflation was surging, with annual CPI hitting 8.5% in March of 2022. Over about a 15-month period ending in April 2022, the Fed increased the money supply by over $6.3 trillion, or about a 41% increase in the money supply over that brief period of time. Creating money was part of the QE process, as the Fed needed those funds to buy treasuries and mortgage-backed securities with its newly created money that took its balance sheet over $9 trillion by the 2022 first quarter, and also suppressed interest rates well below the inflation rate. So the Fed needed to end both ZIRP and QE no later than the first quarter of 2021 if they recognize the dangers of inflation, which us older folks that were investing in the late 60s and early 70s did not need to be reminded about the pernicious effects of inflation. And then they needed to start to increase the federal funds rate off the 0 to 0.25% that they kept until March of 2022, when they raised it to 0.25 to 0.5, just a quarter of a point. And as I said, they needed to start raising that rate no later than the first quarter of 2021 rather than the first quarter of 2022, if they were going to address the inflation problem. Instead, the Fed elected to aggravate the buildup in inflationary pressures, primarily related to supply chain disruptions caused by the pandemic, given its concerns about unemployment. It's mind-boggling that the Fed continued expansionary monetary policies in 2021, notwithstanding the persistent increase in inflation to problematic levels. It is probably not remembered by many investors that the Fed predicted in December 2020, just before the surge in inflation in 2021, that PCE, personal consumption expenditure inflation, would be 1.8% in 2021, 1.9% in 2022, and 2% in 2023. You can find those projections by simply Googling Federal Reserve projection materials December 2020. The actual PCE inflation numbers were 4% in 2021, 6.5% in 2022, and 3.8% in 2024. The CPI increases were 4.7% in 2021, 8% in 2022, and 4.1% in 2023. The inflation numbers have been continuing to move slightly higher as the Fed has cut the federal funds rate, and yet the Fed is once again far more concerned about unemployment than inflation, and has been slashing the federal funds rate, in part, some would argue, due to pressure from the President of the United States, with the next 25 basis point cut likely at the early December 2025 meeting. And it needs to be emphasized also that the Fed is about to restart what I would call light quantitative easing, that it labels an end to quantitative tightening. QE is the correct term in that the Fed will not allow its extremely bloated balance sheet to run off, but can purchase treasuries and mortgage-backed securities with the proceeds of matured ones. And this is why I call it light quantitative easing being resumed by the Fed, even as inflation moves higher. And if Trump is able to secure a majority of Fed members, which seems likely to me sometime in 2026, and even if there's only a slight weakening in the economy or hardly no weakening at all, I would expect QE to return that substantially expands the current bloated balance sheet, and a federal funds rate moving back to 0 or lower than it will be at the close of this year, even if inflation continues to move higher during that period of quantitative easing and cuts in the federal funds rate. Trump will want to juice the economy, and even if that contributes to inflationary pressures, which he says do not exist now. Short-term rates will likely continue to decline in that kind of scenario, even as inflation moves higher. A plausible scenario is that the Fed will sometime in 2026 suppress intermediate and long-term interest rates below the annual CPI rate. All of this creates a quandary for me because of the continuous flow of proceeds that I have from maturing Treasury bills and corporate bonds and to a lesser extent CDs. For now, I'm continuing to buy 40 to 50 Treasury bills at auction each week, mostly 3, 4, and 6 months Treasury bills, and am increasing my allocation each week to dividend-paying stocks and to a much lesser extent equity preferred stocks. Rallies in several of the stocks that I've been buying make them even less attractive to me, given my capital preservation objective being my primary concern. And T-bill rates will be falling as I experience a deluge of maturing ones. I looked at the maturity schedule for January 2026 and took a deep breath after tallying the dollar amount maturing in just that 1 month, and I have maturities occurring every week throughout 2026. One problem with a bond ladder is what happens when rates fall. I benefited from using a ladder approach when I had a constant stream of proceeds that could be reinvested at higher yields. Now I have the problem of reinvesting the proceeds at lower short-term yields. I will need to figure out a new plan sometime between now and the start of next year, and that may involve buying some longer-term municipal bonds, rated AA or better is what I generally buy, to have at 4% tax-free current yields, and that's more interest rate risk than I'm comfortable in accepting at my age, but I may end up doing it to at least to some degree to deal with the problem that I'm going to experience next year.